discussion on credit risk. So, not very complex credit risk modeling, because that way credit risk modeling can go to a different depth altogether. So, we won't go that much, but at least we will cover the basics, which will give you a good starting point as to a few things which frequently get used in the industry. So, things like maybe how ratings get used in. So, a place where we had seen ratings was in CVA, or we have also seen that in regulatory capital charge. So we'll talk a bit about ratings and the ratings process which is followed by within banks. Then giving you an idea of exposure monitoring and limits monitoring, something which you'll extensively use if you happen to join risk management. So either in market risk or credit risk. So that is where you'll have to monitor limits. So what are limits and why do we require them? That is something which we'll cover as well. All right. So before we begin, let's do a simple working in Excel. So I mean, when I say do a simple Excel, I mean I've already done that Excel working. So I'll just walk you through the Excel, and then I can email it to you guys. You can check it out later. So that's a simple example of how exactly a HSVAR can be calculated. So the last time we already discussed the approach for historical simulation VAR. So if that has to be done in Excel, then how that can be done, we'll see. Again, this is a simple demonstration, so there is no programming here as such. I mean, I have simply used simple Excel formulas. So let me share my Excel. Okay. So a simple Excel which I have created for demonstrating how an HSVAR would work. So this is exactly in line with what we have discussed yesterday. So the discussion on the whiteboard, this is exactly the same replica of that. I've just taken some hypothetical rates. So imagine that I have these 5 tenor rates. So let's say these are the 5-year rates. So this is 1-year rate, 2-year rate, 3-year, and so on up till 5 years. And these are all my historical data. So the first column is actually a day counter, and this is my closing rate. So imagine that at the end of every day, I have a batch process which will run, which will populate these rates for me. So imagine I've simply done a querying on my database and I've got this data with me. So that's all that I've done, nothing else. And I think there'll be one more row in the end. Yeah. And there is a row number 253. So this 253 represents today. So you can call this as today for now. So let's say today, end of the day has happened, and these are my closing rates as of today. So the first 252 rows are my historical data, which I query from my database. And this row is the rates which I have fetched right now. So imagine that I have access to FIMDA, I have a FIMDA membership or login, and I have downloaded these rates. So this is my input. So this you can imagine is similar to the table A, which we had shown yesterday. Then as a first step, I have to calculate my day over day returns. So here I have simply taken log returns. You can simply take percentage returns as well. The numbers are very, very close by, so that's not a problem. I've just chosen to use log returns. No problem. You can use normal returns also. I do the same thing for, or rather, it's like a day over day change which has been done. And again, I simply do it for one of the tenors, and I simply copied the formula elsewhere. So I don't have to rewrite the formula again and again, just copy and paste the formula. But this you can imagine is the table 2, where we calculate the percentage change in risk factors. Or when I say returns, you can also say percentage change in risk factors, something like that, something which we said yesterday. Then I need to do the scaling of risk factors, because finally we need to relate these changes in risk factors to what is happening today, right? Because we are interested in the scenario today. That's why this kind of scaling is required, which is nothing but creation of simulated RFs or simulated risk factors. So you can also imagine that this is the same scenarios which we had called. So we had 251 scenarios. So you can imagine this is scenario 1. The second row is scenario 2, then scenario 3, and so on up to 251 scenarios. So these are like zero rates which are scaled, and these are simulated numbers which are available for my consumption. So once this is ready, I can begin with my exercise. That is, I can start with, let's say, P1, then I can do P2, and so on up till P251. So imagine that this is the PIs which we had discussed yesterday. So these are my PIs. I'm not, I mean, these are not my PIs really. I'll be using these for my PI purposes or calculating the present values of individual steps 1, 2, up till 252. And again, I use simple discounting. So I think the bond specifications I have written on the right hand side. Yeah. So I have a face value I have assumed as 100. Coupon is 7%. Frequency I've kept it as annual for simplicity. Tenor is 5 years. So coming back, I start my scenario wise pricing. So imagine that this first row is my scenario one. So the first four columns is nothing but calculating the PV of my coupons, or these are the discounted values of my coupons. And the final thing is the discounted value of coupon plus the discounted value of the final face value or 100, which we are doing. So if I sum all of these up together, I get a bond price for scenario one. Again, if I just hit a F2, you'll see that I've simply added up these things. So that way, I've just kept the calculation simple. I've done the PV calculations here, and I've simply summed them up in this separate column. So this becomes my bond price or simulated, or this is what we call as a simulated MTM, as we did yesterday. So this is actually my P1, P2. So maybe I can do a control X, do a control V. So P1, P2, P3, and so on up till P251. So there'll be 251 rows which are available. So these are my 251 scenarios. Now I need to price the bond as of today as well, right? Because my next step is calculating simulated P&L, which is nothing but the difference between PIs and the P, which is the bond price today. So I haven't really priced the bond as of today. So that is what I do in this block here. So I've done bond price today. Again, simply I've plotted the timeline and I've discounted these coupons. So I've just hard coded this for demonstration. I've just taken it as 7 units directly. But basically calculating the DF of the coupon payments and the final face value plus the coupon. So 94.58, this becomes the price as of today. So this you can imagine is my price capital P. I have capital P and I have individual PIs, which are my scenario wise prices. Now I'm good to do my simulated P&Ls, right? I have to just take a simple algebraic difference, PI minus P, and I do it for every scenario. So that I do here. So a simple subtraction for all the 251 bits. Now I would ideally want to do a simple lookup here, but I can't do a simple lookup right now because the order in which these numbers are appearing is erratic. I would like to have them in a descending order. So for simplicity, I have just copied and pasted this in a next sheet. And here I have sorted it. So here I just sorted that in a descending order with my lowest numbers first and then my highest numbers. So I start with minus 3.6 and I go right until 3.4. Now, I don't need to worry about something beyond observation 3 because I'm looking at 99% one-day VAR. So I'm going to report the third worst observation as my VAR. So this minus 2.95 is something which I would like to report as the VAR for this fixed income position or for this bond which I'm looking at. So this is just translation of the things which we have done on the whiteboard into Excel. So does this sound okay? So later on, I'll anyway share the Excel with you, so that's not a problem. But at the moment, if you have any questions, please let me know. Okay. So that way, this can be automated as well. So you can either do it in, so you can use any tool. Even a simple VBA should be fine because this is a small portfolio, right? As the portfolio size increases, then that scale is something which you would like to address through some good quality scripting tools. So, but for at the moment, I mean, even a normal Excel or VBA should suffice. But right now, focus on the approach because that is more important. Once the approach is clear, then converting that into any programming language is not difficult. So opening the presentation again. So HSVAR we discussed, and I mean it's a very frequently used approach, and it's not very difficult as well. I mean you can use the same approach for any product type. Only thing is your set of risk factors changes, and the set of your or maybe the set of pricing models which you're using, that will change. But otherwise, more or less, the approach remains the same. Advantages, drawbacks also we discussed briefly the last time. We'll talk a bit about Monte Carlo in some time. Maybe let's complete back testing and stress testing first. So when you say stress testing a certain model, could you tell me what stress testing means and why do we require it?
So you can use stress testing if you want to know the impact of adverse events on your portfolio.
Correct. Good.
So
So
basically,
yeah, sorry, please go on.
yeah, correct. Go ahead.
No, sorry, please go on. I mean, I cut you off.
No, no, so that's what I was saying. Basically, you want to simulate some very extreme events, like very high volatility or something like that, and then
Correct.
you want to see where where you're gonna land.
Correct. Good. Yes, so the idea of stress testing is to ensure whether your models and frameworks are robust enough to handle any kind of system stress which may build up over a period of time. Because system stress can build up at any time. It's hard to predict when that will happen. So what regulators insist is banks should have a very robust stress testing framework, and they also set a certain set of guidelines around stress testing. So in India as well as in India also RBI has set a stress testing guideline which banks are expected to follow. So even when we talk of value at risk, you have what you call as a stress VAR, which is calculated. So to calculate stress VAR, what we do is we pick a data from a certain time period whereby there was extreme volatility in the market. So maybe something around 2020. That can be a good example, a recent example, because during the COVID time, there was unprecedented changes in the market and a significant volatility as well. So possibly 2020 could be one year, which could be used as an input to the data in order to calculate the stressed value at risk. So the idea of this stress testing is if something has happened in the past, it has a potential to repeat again in the future. So, so that's why we take into consideration such historical time periods and then we use it in our stress testing analysis. Now, when we talk of the stress framework, there are two ways to it. One is RBI driven stress scenarios, which we call as the regulatory stress scenarios. So these are something which banks are expected to follow. So there's no two ways about it. But in addition to that, what RBI recommends is banks should also do their extensive stress testing themselves. That is, banks should try and create as many hypothetical or plausible scenarios which can happen in the near future so that they are able to test their portfolios against these kind of stress levels. So that way, the regulator also gets confidence that bank has done ample amount of testing. So in case the stress does build up in the system, then the banks are well equipped to handle that kind of a stress. So that's why these internally developed scenarios are used along with the RBI stress scenarios as well. So the reporting of stress results is something which is done to the RBI at the end of every quarter. So let's say I'm talking of stress VAR. Then the stress VAR, although it's calculated every day, the reporting will happen once every quarter. Of course, that being said, RBI can give you a call at any point in time asking that, can you let us know what is the stress VAR number as of yesterday? So at that time, you need to ensure that you have the data ready. So you can't tell RBI, our system is running and we'll let you know in a couple of days. That's not acceptable. So banks ensure that these kind of things run on a daily basis. So generally, you have a batch process which runs for a VAR and stress VAR as well. And generally, overnight these things get ready. So let's say right now it's 7 o'clock, and imagine that the market data has come in. So after cleaning the market data and doing the required curve settings, etc., the pricing of products begins, and finally after that we can apply for the VAR calculation as well. So roughly 4 to 5 years is 4 to 5 hours is the time it takes for this entire cycle to complete. Because the thing is, along with stress VAR, there are other things which the bank system does as well. And the system's infrastructure is always limited because there are multiple teams which are using the same set of system resources. So that's why generally 5 to 6 hours is considered as a decent error approximation, at least for a bank in India. Globally, I'm not sure how long they take, but maybe for larger banks like JPM, etc., they may have a more sophisticated IT infrastructure. So possibly they may be able to generate the results at a faster rate. But honestly, as long as the results are available on the next day, that's good enough. Now, whether you get the results in 1 hour or 6 hours, I don't think that makes much of a difference. As long as the results are correct and they're available for consumption the next day. So this was about stress testing. Any questions?
Yes, sir. Sir, does stress testing, include white swan events? Sorry, butterfly events.
Uh, so when you say butterfly event, could you elaborate?
So I'm not exactly sure if it's black swan or butterfly. Like
So
COVID was out of the blue, basically. Like
correct, correct. So black swan is comparatively difficult to find because you never know when such kind of events hit the market. So banks will always try their best in order to capture as many extreme events possible. But targeting a specific black swan event is really difficult. So I don't think that is something which is possible very easily. Maybe as a part of your stress scenarios, that event or maybe a part of that event might get captured. But separately focusing on specific black swan event is kind of difficult because
okay, sir.
that's why it's called as a black swan, right? No one knows when that is going to happen.
Yes, sir. Because the unpredictability, the main thing is it's unpredictable that no one can see it coming. So
Exactly. If any bank can forecast that, then I mean they'll be at the forefront and they'll know what exactly is going to happen. But that is kind of difficult to estimate. Okay. So this was a brief on stress testing. Now coming to back testing. Now back testing a model basically implies how good your value at risk model is behaving. Because when you say that you're using a VAR model, what you're trying to do is you're trying to do a 1 day ahead estimation of what could be your maximum portfolio loss with a certain level of confidence. So when we do back testing, what we try to do is we try to compare this VAR number with the actual P&L, which will happen tomorrow. So if I have a VAR number for tomorrow's portfolio, which I calculate now, then based on, so once I reach tomorrow, let's say I reach tomorrow's end of the day and I have to actually calculate the portfolio P&L, I can compare that versus my VAR estimation. So as long as my portfolio loss is not breaching VAR, I am happy. So that is what we do under back testing. And for back testing as well, what the regulator does is it defines three zones into which it would like to classify a certain bank's VAR model performance. So again, back testing is something which the bank will like to do on a daily basis, although the reporting happens once every quarter to the regulator. But what regulator tells banks is you can divide your, or maybe the regulator will divide the banks into three areas, I would say. So one is green, a green zone, an orange zone, and a red zone. So the idea of zoning banks into these three areas is to classify a certain bank based on the number of VAR breaches which happen. So when I say VAR breach, that means whatever VAR number I have calculated, the loss on the actual portfolio has breached that number. So that is what we call as a VAR breach. So when you say you're having a 99% 1 day VAR, you generally are okay with having losses up to 2.5 or maybe 2.5 breaches per year should be good enough. So 2.5 is roughly 2 or 3 breaches a year. So as long as your number of breaches stay within this area, RBI is happy. So regulator says, okay, your model is decent enough and it is behaving as per expectations. So fine, you can continue using the model. Let's say the number of breaches exceed, let's say 3, and maybe they go up to 5 or 6. I don't recollect the exact boundary for this, but that you can check in the regulatory circular as well. Let's say number of breaches are more than 2.5, but they are less than, let's say, 5. Now the RBI says, fine, and your model is able to capture risk. Only thing is, a couple of times it was not able to understand what exactly happened on the portfolio, and the VAR breach happened. So they would say that maybe you could review your model internally and possibly see if you need any kind of enhancements. So that could be an advice from the RBI if a bank falls in the orange zone. Now, if the number of breaches increase, let's say 5 or 6, whichever, now, then in this case, what a regulator would say is you get your model reviewed, maybe by an independent third party, so that they will give a fresh look to the model. And if the third party finds a considerable amount of mistakes or shortcomings in the model, what we would advise is you go in for a complete revamp of the model. So that is something which can be advised by the regulator. So generally, your backtesting performance will be classified into these three zones, and based on that, a certain action might be recommended by the regulator. Now, again, backtesting and testing are important, not just from your regulatory point of view, but from your management's point of view as well. Because whatever stress testing numbers or stressed VAR which you calculate, that gets reported as a part of your internal MIS daily. So your top management knows what exactly is happening on the portfolio, and that's precisely the idea, right? Because your top management needs to be sure as to what is happening at a portfolio-wide level. So what the regulator says, that's a different thing. Regulator, anyways, is concerned with what is happening on the portfolio, but your management also needs to be up to date on things. So as a part of your daily MIS, your bank's middle office is going to generate the reports on stress testing or back testing, which is computed by risk. And those reports will be circulated within the organization for their consumption. But again, these are the things which have to be ready at all points in time. So not just quarter ends or month ends, but at any particular day as well, because your regulators, auditors can come asking for this data at any point in time. So bank needs to be sure that their systems are in order and they're able to generate these reports at a specific frequency, which is essentially daily. So these numbers have to be available for their consumption. And just one idea on RBS. Yeah, I think there's some question. Is it? Yeah, Ali, please go ahead.
So you're saying that the RBI will advise or recommend. So is it not a regulatory requirement to have a good VAR model?
So regulatory requirement, yes, but again, how the VAR model is constructed, etc., and any assumptions which the bank is using, that is something which the RBI does not comment on. But RBI expects
But-
that your VAR model is performing as per expectations. If there are problems, then they may suggest a few recommendations.
So exactly, so in that case, it's a conflict of interest, right? Because banks will always want to have a model that is more favorable, like more risk. What's the word? Risk loving, or like because banks will eventually want to take on some risk.
Correct,
So
but
they'll
correct. So to
yeah, go ahead.
address that issue, what RBI has advised banks is they should have an independent model validation unit as well. So bank need to have their models validated internally, either by an independent team within the bank or by an external consultant. And it is the responsibility of the validation team or the external consultant, whoever is employed, to ensure that whatever assumptions are being used in the VAR model are correct. If something is unreasonable or if the bank is trying to push the level of risk higher than what is warranted, then that is something which will immediately come in those reports. And those reports are consumed by the auditor and regulator. So that way, RBI keeps a check on things.
Okay, sure, sir.
Sorry, we're talking of RBS by mistake. So there's something called as RBS or risk-based supervision. So I think I just missed adding those points here, but we can discuss that. So a couple of things from regulatory supervision point of view. So one is risk-based supervision or what we call as RBS. And second is on-site inspection. So as a part of the overall banking operation, the Reserve Bank requires banks to stay up to date on things. And for that, RBI does a couple of activities which are considered pretty important from the bank's point of view as well, because any kind of breaches or shortcomings which are spotted in these activities can be seen unfavorably by the regulator, and they may want to start certain regulatory action against the bank. So first is RBS or risk-based supervision. So the idea of RBS is to ensure that bank is able to aggregate all the risk data, and that risk data gets reported to the regulator in a specific fashion or in a specific format. And this is an activity which happens at the end of every quarter. So if I recollect, RBS data needs to be submitted or needs to be uploaded on RBI's website 3 weeks after every quarter end. So today is a quarter end, or rather it's a year ending date, 31st of March. So banks are expected to report their RBS numbers latest by 21st of April. Generally, RBI gives a date, but generally it's third week of the following month, of the month which follows the quarter end. So RBS comprises of several data points. So I think roughly 100 odd data points are there. And these data points will be divided amongst risk teams or amongst banks or amongst teams within the bank, not just risk, but otherwise as well. So things like maybe what is your VAR number right on a daily basis. So starting from 1st of Jan up till 31st of March, what was the VAR for your portfolio? That is something which will get collated. Maybe second can be what was your daily capital charge. Third could be what was your duration of the bond portfolio. Maybe fourth could be what was your exposure for a certain counterparty. Now, all of these things so what all things have to be submitted? They are clearly mentioned in the RBS data. It's only the bank's responsibility to ensure that all that data gets aggregated and reported to the RBI in a correct fashion. So for that, RBI has created their own portal whereby banks can upload data. So generally, the way in which things happen here is it's like a two-eye check. So risk-based supervision data will be prepared by respective risk team members. So rather, I would say it's like a three-level check. So within the risk team, a couple of guys will prepare the numbers for RBS because the size of data is very large. And those banks which continue to rely on Excel have to especially be very careful because you never know if a certain Excel formula doesn't get updated. Because imagine that you have an Excel sheet and you're updating that Excel sheet at the end of every quarter. So even if you miss changing on the formula, then that will mean that you're reporting older or stale data, which is something which is unacceptable by the regulator. And since it is unacceptable, and banks have to be very, very careful when they're using any kind of Excel. So that's why there is an increasing effort of moving things onto scripting or something which is driven by a ready tool. Because the thing is, making operational errors in these kind of activities is very high. Because let's say an analyst is preparing the RBS data, but maybe he or she misses on updating a certain data point. That can be a problem for the bank. So to avoid this or to maybe curtail this risk to a significant extent, there is a maker who will prepare these numbers and there is a checker who is going to independently verify whether all of the formulas have got updated and whether all the cells are filled before uploading the numbers on RBI's website. Now, after the checker, this thing generally goes to your compliance team, your internal audit and compliance. Now, why internal audit and compliance? Because they are like the first line of defense for any bank. So whenever there are any questions from a regulatory point of view which come in, it's the internal audit and compliance guys which address them first. So generally these points, once they're verified by risk, they are sent to internal audit for a quick check. So they quickly review the things from their end and they push the numbers on the compliance or on the website of the Reserve Bank. And once that is done, RBI can consume those data for their review purposes. If there are any gaps which are found, then the RBI immediately starts a regulatory action. And I think it's a regulatory action against the individual who is filing the numbers as well as against the bank. So that way people are also very careful when they do these activities. And other is the on-site supervision. So on-site supervision is the activity whereby Reserve Bank officials will come to your bank to understand your processes. So generally, they let the bank management know a couple of days in advance that they are coming in for on-site inspection. Generally, the lead time is small because that way they want to keep that element of surprise as well, right? So maybe everyone is happy to leave on a Friday evening. Let's say people have planned a nice party, and then suddenly, just before leaving, your boss gets a call from the RBI saying that our officials will be there at your bank on Monday morning, 9 o'clock. Now, if everything is in order, then fine, that party scene can continue. If not, then everyone has to stay on the weekend to ensure things are right. Because if the RBI finds out there are gaps in processes which are being followed, they can immediately start a regulatory action against the bank. And the on-site inspection is pretty important that way. So at that time, you'll see that all of your top management is also present. So I'm not saying all, but majority of them. So at least those who are engaged with the day-to-day activities. So something like someone like a CRO or head of trading, they will be around when this inspection is on because they also need to be sure that in case a question comes up from the RBI, that is immediately addressed. So generally for this on-site inspection activity, a couple of senior members within risk will be appointed to talk to RBI officials when they come to meet them and answer any queries or questions, etc. But also the other team members also need to know what exactly they do in and out because RBI officials can ask you casually. And so what do you do on a daily basis? So at that time, if you're able to articulate exactly what you do and the checks and balances, that gives RBI a kind of confidence that fine, and things are in order. So these questions can appear very innocent at times, but if you miss out on something, then the RBI may fire it in their report saying that there is a gap or a shortcoming in the process, something which is seen unfavorably by the bank's management as well. So that way, on-site supervision is something which is seen very, very seriously by the RBI and also taken seriously by the management. So generally, those 3-4 days, RBI officials are around and they are basically there to verify if things are in place. So any questions on RBS or on-site supervision or on-site inspection?
Sir, what software or tools they usually use for VAR calculation and all?
So that depends on the size of the portfolio. If the bank size is very, very small and if they don't want to spend money on technology, Excel. If they want to enhance Excel, but they don't want to spend much on enterprise risk systems, or let's say their uh, bank scale is not that big, which doesn't warrant them to purchase a Murex or Calypso, then maybe they could do it in Python or R as well, or any other scripting tool. And now, if they have a big enough scale and they're able to afford expensive systems, then Murex or Calypso. Another option can be bank can separately purchase a SaaS as well. But again, Murex or Calypso or SAS, these are expensive systems. So banks with a scale will be able to afford them because finally, I mean, that cost needs to be recovered in some way. So if the bank is big enough, or if it's a mid-sized bank with a growing book, then yes, they may go in for something like a Murex or Calypso and SAS. Otherwise, they could stick to Excel or open source.
Okay, sir. Thank you.
Okay, I'll just give you an idea of how Monte Carlo simulation or Monte Carlo VAR gets done as well. So maybe I'll just go to my whiteboard and I'll stay on the whiteboard. So I'll just give you the steps. So that way the steps appear very easy, but tuning and getting a Monte Carlo VAR running is not very easy. Okay, so if we have to calculate a Monte Carlo VAR for, let's say, an IRS, for example, for example, take any product, but maybe we could talk of IRS here. So firstly, once you have a product, you need to fetch the trade details. So I'll just give you a rough flow for this, because these are required to understand what is the product that you are exactly trying to calculate risk for. So fetching trade details like your start date, end date, and any other conditions which are there on the swap. Next is we are going to require a good quality interest rate model. So it could either be a Hull and White model or maybe a Black Diamond or etc. But generally, Hull and White is something which is generally preferred. There can be other advanced tools as well, but any decent quality IR model should be good enough. Next, you also require a random number generator. Now, why we require a random number generator is because we are essentially trying to do something like this. So let's say I'm standing here today, and from today, I am trying to simulate various interest rate paths. Let's say 1, 2, up till n. So we can actually combine IR model and random number generator, because without the random number generator, IR model doesn't make much sense, but fine. So the idea is we have to simulate n number of interest rate paths, because finally we have to calculate or we should have as many scenarios as possible. So let's say we decide on a certain value of n and we do those many simulations. That is, I'm trying to simulate an interest rate for each of these paths. And once I have that interest rate path, I have to work on individual path at a time. That is, so firstly, what I can do is once my simulations are done. So basically 2 and 3 are, or maybe I can add a 4 as well. Generate n paths. So 2, 3, and 4 are extremely computationally intensive because you decide on a value of n which is considerably large, because now you don't have a restriction of 252 days. For historical simulation VAR, we had 252, right? Now here you can have as many number of scenarios as possible. Of course, you have to balance that out with your system infrastructure. So 2, 3, and 4, I would say is immensely computationally intensive. Once that is done, I can calculate the price of the IRS today because I have the closing rates for today. So I can price the value today, which I can call as the MTM today. And let's say I call this as capital P using the same terminology which we had used for our HSVAR thing. And then what I do is I start using each path one at a time. So I take path one, I use these rates in order to price the swap. So using path one, I can get P1. Then I go to path 2, I get P2, and so on up to path n, I get Pn. So each of these individual paths are priced as well. And after that, I need to calculate my, so these are basically my simulated MTMs. So the idea is similar to earlier. Only thing is at that time we had historically simulated risk factors. Now we are simulating something new. We are not dependent on history at all. So simulated MTMs, which we show by
So what you
PI.
have written, that is MPM, right?
MTM, yeah, sorry.
Yeah, right.
Actually, I was tracking Mahindra and Mahindra in the morning, so I wrote M and M by mistake. It is MTM. So P and PIs. So my simulated MTMs get done for each of the paths. And finally, I need to calculate my simulated P and L as well. So that's nothing but the difference between P and individual PIs. And finally, just look up the VAR. So these steps look very, very easy. But actually, this is a comparatively complex activity and a very time consuming activity for the system level as well. Because when you say you're trying to simulate these many interstate paths, that's a very computationally intensive activity because you may be working on, let's say, 1 lakh paths. Now, generating 1 lakh paths may take considerable amount of time. And imagine that you have to price, let's say, multiple IRSs using these. Then that may take even longer because firstly you start simulating the paths, then you have to price each of your IRSs and then use it for your VAR computation. So I would say if there is some way to optimize 2, 3, and 4, then that is something which can speed up the whole process. So one way to do that is to use parallel computing. So before we go to parallel computing, any questions on this? So that way the approach is very similar to HSVAR. Only thing is rather than depending on historical data, we are just simulating new data and using it.
Sir, in random number generator, like what you have drawn, is it like same like geometric Brownian motion?
Yes, only thing is GBM is something for equities, and here we are talking of rates. So either a Hull and White or a Black Diamond or a LIBOR market model. But yes, it is something similar. So you could have an equation like DR equal to something of DT plus something of DW. So a similar structure to a GBM, yes.
So that's the differential, right? Differential of rate is
Yes.
differential time and
So
differential
this is
rate.
just something similar to DS. So DS was RS DT plus sigma S DW. So this was for equity or for stock. So in place of in place of S, I can have R and I can model an interstate path. Now, what goes inside these brackets A and B will determine what model you're using because DT and DW will remain the same. But the form of A and B will keep on changing. And based on which model you're using, that A and B will keep on fluctuating. For equity, it is easy because we just have one model, right? This is the only model for equity, nothing else. But for interest rates, that is not the case. We have multiple models to use. So you need to pick one which is, so again, the thing is you have to decide between complexity and efficiency. So many people might feel that one should go in for the most sophisticated model. Now, honestly, just using that as a factor to make a decision can be risky because a very complex model might be immensely time consuming and which can have an impact on every other activity which you do. Whereas you may actually go in for a comparatively simpler model, which will give you a decent enough estimate, which is good enough. and which will save considerable time. So in that case, I would say that go in for a simpler model, because firstly, simple model has lesser assumptions. It's easy to manage. Now, you should think from your employee transition perspective as well. Let's say a couple of people who are managing this model suddenly decide to put in their papers tomorrow and leave. Then someone who is coming on board should find it easy to manage that model as well, because these are regulatory stuff, right? So these have to be managed carefully. So that way, I would say simplicity is the key. So just pursuing simply complex things doesn't make sense. If they are really required, then yes, but otherwise, stick to basics. That is something which is much easier to manage. So, any computer engineers in our class, or anyone with, let's say, a science degree with computer science or some, or anything pertaining to technology? Okay, so have you heard the word of parallel computing before? Have you heard these words before, or maybe read about parallel computing somewhere?
Yes, sir. In case of supercomputer clusters, two things: parallel computing and something called as embarrassingly parallel computing.
Okay.
IBM Sequoia a few years ago was the most powerful computer ever made. So it used something called parallel computing. I was just reading about it a few days ago.
Okay, okay. So generally, what would a parallel computing do? In any idea?
So from what I gather, it can do. It's like dividing the computer processes, and one part will do. Supposing like we have done the Brownian motion here, so one will do say 50 simulations, the other will do 50 simulations, and then we'll see that if there are somewhat similar or different, something like that.
Correct, correct. Good. So yes, the idea of parallel computing is to speed things up. So as a part of my course on Python, I do parallel computing with our candidates as well, but generally give an idea as to what parallel computing does. So immensely useful from scenario analysis, because let's say I have three scenarios to do: S1, S2, and S3. Let's say these three are my regulatory scenarios, and I need to do this on a daily basis. There's no other way out. RBI says that this has to be done. Now, there are two ways in which this can be managed. So, on a normal laptop, so normal activities which we do, things are done serially. So, there's a serial and there's a parallel. So, in serial processing, what will happen is I do S1, then I do S2, then I do S3. That is, my program control begins with S1. S1 is addressed first, everything is executed. Once S1 is completed, then my control goes to S2. So until S1 is running, S2 and S3 remain idle because this is serial processing. So all of the computing power gets dedicated to S1. Only when S1 is completed does the control move to S2. So once S2 is on, S3 is still off. We haven't really touched S3 yet. Once S2 gets completed, the program control focuses on S3. And this is how normally we do things. So most of the activities which you do on a day-to-day basis, things happen in serially, which is fine. But there are certain specific activities which are very computationally intensive. One can be Monte Carlo simulation, other can be scenario analysis. So scenario analysis is forms a part of stress testing. So you can imagine that these are regulatory defined scenarios, and imagine that these take a lot of time. So let's say S1 is the biggest scenario. So this is extremely time consuming. Uh, S2 is pretty decent. I mean, S2 doesn't take that much amount of time. And S3 is the fastest. Imagine that this is like the size of the computations to be done. So when I say I'm doing things parallelly, what I do is rather than writing S1, S2, S3 this way, I write them in a different order. So I write them this way. And as a part of this, what I do is I tell the computer explicitly that you start working on all the three scenarios at a go. That is, you start S1, you start S2, you start S3. So I don't tell the machine that you wait for S1 to get completed and then go to S2 and S3. That doesn't happen. Now the processing begins. And the thing is, your computer's processor is very, very powerful. So that way you need to only leverage the power of processors, because there are multi cores which are there inside these latest processors. So you should try and leverage that computational power as much as possible. So the idea is all of the three things begin uh, in one go. So S1 gets completed first, then S2 might get completed, and finally S1. So S3, S2, S1, in this order they could get completed. So what we do is after this, we collate these numbers. So whatever are the outputs from each of these processes, we collate it on a layer, and subsequently we generate our report. So maybe once these numbers are collated and arranged in the required order, we can simply generate a report. But the thing is here you're saving time because you're not keeping anything idle, right? You're trying to use your computational power as much as possible. So that is how you can optimize things. So especially around simulations or maybe stress testing or scenario analysis, parallel computing is the key. So those of you who are interested on this computing side of things, this is something which you can definitely explore. Also, another thing on parallel computing which you guys can check out is a GPU, which we call as a graphical processing unit. So every laptop has a very robust and a strong graphics card. So there is a way to leverage the power of that graphics card as well, which we call as a GPU processor. So maybe this is something which you can check out. So either parallel processing or GPU, depending on what applications you want to handle, you can decide which approach you want. But again, something which is very interesting. So those of you who like technology and would like to explore things, this is one thing which I would definitely recommend that you guys check out. And maybe this may fall in line with your big data things as well, because you're anyways learning data analytics, right? So many tasks in data analytics can be time consuming. So at that time, parallel computing can be done. So I have used parallel computing for value at risk. So it was done for a simple options position, but that can be extended. So, I mean, with Python, things become easy. But if you're working on something like a swap, whereby you need to do an IR model, then things can get complex. With equities or FX, it is comparatively easy, but for IRs, it takes a separate effort because then firstly you need to configure your interest rate model, and subsequently you need to simulate things, which takes time. But again, maybe those of you who are interested, you can do that as a project for yourselves. So that will give you additional clarity on things. So again, IR modeling is something which is interesting and challenging. I can give you pointers. So those of you who are inclined, I can let you know the things which you can check out later on. But otherwise as well, I mean, you can apply these things for other applications also. So this is something in finance. I'm sure there'll be other applications in so I mean applications in other industries where parallel computing might find some use.
Sir, is it like crypto mining for GPU? Like,
Uh, I'm not very sure because I don't know how to mine cryptos, but the idea behind this is to optimize your system resources. So if that is something which crypto mining does, then it could be similar.
so because all these memes are like people are scalping or buying GPU by the dozens and then putting it up on server farms to mine. Like they
Correct.
just put it there.
Correct. So something similar, yes. So they will be leveraging power of parallel computing because I mean, cryptos are used to solve some complex tasks. I don't know what that task is, but yes, but, optimization is something which they would always want to do. So
So,
possibly those of you who join maybe a crypto exchange or something like Zeppay or something, you may. So maybe after that, you tell me how exactly things happen because I don't know.
sir, it is used in Pune at ISER.
Okay,
Crypto for
okay,
cryptographics, not that brute force hacking and that intelligence signals and all.
okay. So I think ISER is the one near Baner, is it?
Yes, sir. Directly about directly opposite Yashoda.
Yeah. Because I think because I was traveling to Pune a couple of weekends back. At that time, I had seen that. Okay, good. So, does your institute have a tie-up with them? So, possibly any chance you guys can check that out.
So we don't know, but whatever research is going on there, it is bound to be very high level.
Of course, yeah. I mean, they may just give you an overview, but that is good enough as well. I mean, they may not give you direct access to system because if it's something which is very confidential, they can't disclose that. But at least they can give you a few ideas as to how things happen, which could be useful. So maybe you can check out with your management in case they can do something for you. Yeah. So let's go back. So what's the time right now? We are at 525, 528. Okay. We are at 528, 529. So should we take a 5 minute break and then begin with our discussion on ratings?
Yes, sir, please.
Yeah. Okay. Okay. All right.
Yes, so that would be nice.
Okay, guys, can we begin? Is everyone back?
Yes, sir.
Okay. So now let's discuss a few things on credit rating. So maybe understanding the process, the relevance, and applications of credit rating, because it's a important concept and something which is frequently used within the industry. So when we say credit rating, that basically implies uh, some way of quantifying the kind of credit risk which a certain issue or a certain issuer is carrying. So there are various agencies which issue credit ratings. So that is what we call as rating agencies. So someone like S&P or maybe Moody's, Fitch, etc. So these are popular rating agencies, someone who have been doing credit ratings for a very long time. So they know the business model, and I mean they have ready systems and processes which can help them with a quick turnaround time as well. So if a company goes for credit rating itself, or maybe one of its bond issues, that is something which these rating agencies can support them on. So, when we talk of factors which are considered for credit rating, there are a variety of factors which rating agencies generally take. So, a few of them could be firstly the macro factors. So, something which is happening on the economy wide level. Then, something which is industry specific as well. After that, maybe a comprehensive company analysis. Also, generally checking what the business cycle is, because business cycle keeps on changing. So where is the business cycle at the moment? Also, maybe talking of consumer confidence, because finally these could be your end customers which would drive the volumes of a certain company. So maybe consumer confidence, and so when I say macro factors, you could have things like maybe what is the expected growth rate, what is the inflation rate, etc., or maybe what is the jobs information. Also things like fuel prices, maybe also take into consideration geopolitical issues. So, in case something goes wrong with Russia, then how exactly does India tackle the problem for fuel imports, etc.? So, those are things which might be studied as a part of macro. Then, some bit of industry specific stuff, because every industry is unique in itself. So, yes, economic analysis is important, but also how a certain industry operates is also equally important. Then looking at a certain company which they have to do a credit rating for, so understanding their financials, etc. So we'll understand the process which is followed as well. So at that time, a few of these points will get repeated. Then looking at the business cycle which the economy is at the moment. So, and is the market optimistic, or and do you see a difficult time for the economy going ahead? Also checking what the consumer confidence is, because consumer confidence reflects from the overall consumer behavior. So the way in which consumers are spending or making their investments, etc., that gives an idea as to how exactly the individuals or even small term investors are expecting the market to behave. So based on that, their confidence can fluctuate as well. So I think these are a few factors which are popular when we talk of credit ratings, and I'm sure there'll be many other factors as well which rating agencies do, because they are specialists in this activity. So these are pretty straightforward point, but I'm sure there'll be something which is specific to a certain issue or issuer which they would want to review. Then the idea of ratings downgrade. So when you say ratings downgrade, it's easy to understand. So let's say we have a rating scale, something which is popular with S&P. Now this is like a standard rating scale which we have been using for a long time. So when you say a rating downgrade, let's say a certain bond is rated AAA, but maybe in the next quarter that rating drops to AA. So this basically means a downgrade, because earlier something which was rated AAA is now rated just AA. So this is like a credit downgrade. So similar to downgrade, there can be an upgrade as well. So I mean, credit rating uh, drop is yes, but along with that, if a certain company's condition improves, then it can go for an upgrade as well. So someone who was rated AA could go into the AAA category as well. So that's what we call as a upgrade or downgrade, as we call it. So upgrade and downgrade. Also, the idea of a rating outlook. So when you say rating outlook, what does it mean? And what's the requirement for rating outlook? Anyone?
Or it's a read on where the rating is going to go in the coming period.
Correct, correct. So the idea of a rating outlook is to reduce the kind of volatility which we observe in credit rating changes. Now, there's a specific reason behind that, because if credit ratings agencies start rapidly changing ratings, that is, if they every quarter to quarter they're changing ratings for entities, then that can introduce a considerable volatility for the consumers of these ratings. So especially banks or financial institutions who consume these ratings actively, they are going to see a considerable volatility in maybe their capital charge numbers or maybe their exposure reports, or any other points which are linked to credit ratings. So in order to reduce this kind of volatility and to maybe smoothen out these fluctuations to a considerable extent, rating agencies have introduced the idea of a rating outlook. So when you say rating outlook, they may either have a positive, negative, or a neutral outlook. So let's say they have a positive outlook. So a positive outlook, and let's say a certain company is rated A at the moment. Now, if a company's rating is A, and if the rating agency says that we have a positive outlook on this XYZ company, then this means that there is a very good chance that going ahead, this company is going to see an upgrade in its rating. So maybe A can become double A in probably the next quarter or quarter after that. So this is the meaning of a positive outlook. There can be a negative outlook as well. So someone who is rated A, rating agency may say that we have a negative outlook. We are not very optimistic about them. So this is a sign that possibly A could drop to triple B. So this is what we call as a negative outlook. There can be a neutral outlook as well. So in case the rating agency doesn't specify anything explicitly, that means they are pretty neutral. They don't really have a specific view on that. So this outlook is the way in which rating agencies try to express their views. Only thing is they don't immediately change the rating at that time, but that is a signal to market participants that that certain issue has a certain outlook. So there is a potential that their rating might change going ahead. So that way, market participants know that fine, this is something which is expected and it's not a complete surprise for them. Now, a few uses of credit rating. So it's useful for arriving at funding costs naturally, because depending on the credit rating for a certain company, the funding cost for a company can change as well. So let's say there are two borrowers who go to a certain bank, and if the rating for one of the borrowers is AAA and for the other borrower it's triple B, then the bank can say that fine, for the AAA borrower we can charge a rate of let's say 4%, and maybe for a B we can charge something like 5%. So this 1% hike is because the bank is taking a risk whenever it is lending to someone who has a lower credit rating, because there is a certain credit risk which is involved for triple B, right? It's not really uh, investment grade. It's just at the cusp of investment grade and junk grade. So accordingly, the funding costs for these entities can change. For A, naturally it will be lower. Or if I call this as A and B, then bank uses credit rating for computing capital charge. So this is something which we had discussed when we studied the capital charge as well as the CVA charge framework. So this happens to be one of the inputs into that model, because your capital charge, etc., helps you decide on your risk weights, and that risk weight is the driver for your capital charge numbers. Also, credit ratings will determine the kind of the boundary up to which institutions can invest in a certain fixed income security. So this is one way in which your organization-wide policy would restrict traders from taking positions in a very lower rated bond, because those bonds which carry a poor rating naturally have a higher risk, and not every bank might be fine with taking on that risk. So they would say that you stick to investment grade. Anything below triple B, we don't want on our portfolio. So that can be like a threshold which is set. So just a related question to this point number 3. Now, you guys have studied derivatives in the past. So if I want to circumvent this particular restriction on credit rating, how do I do that? So there is a legitimate way to do that. So how do I do it?
Could you repeat the question, please?
Yeah. So in case my organization says that I cannot invest in a certain product which is rated below triple B, but I still am interested in taking position and getting exposure to that particular company or that particular product, then how do I do that? And I should not breach the org policy as well.
Short.
Okay, could you elaborate maybe more on that?
So we could say short options. If we truly believe that the bond is junk grade or a high yield bond and expect it to degrade further, then we can basically short it. Like today we'll sell it at a high price, and if we expect it to fall much below, then we can benefit it uh, by the fall in price, basically. So it could be one way. Instead of buying bond, we are just utilizing the or expecting the market timing and difference.
Okay, okay. Any other view?
So can you enter a swap? Like you can take an investment grade bond and you can swap it with the flows of a junk grade bond or something like that.
Yes, so that's also a possibility, yeah. But maybe a simpler approach could be using futures. So that way, generally, these kind of conditions of not allowing firms to trade below investment grade, that is applied for your cash investments. So that is if you are directly taking a position in a fixed income product, that will be like a restriction. You can't trade below triple B. But it can so happen that a certain company I'm really interested in, but unfortunately the rating of that company isn't very good. So maybe it's double B rated, but there are promising prospects for that company. So we feel that going ahead, that company might do well. So what I could do is I could take a position in futures, and that way I get an exposure to that particular company. So as the company's prospects improve, my futures positions improve as well. So either futures or options. So that's how you could use derivatives in order to circumvent this particular restriction on threshold and still stay on the right side of the policy. Okay, and provides a classification between investment grade and junk grade. This is fine. Okay, so any questions on this slide?
No, sir, got it.
Sir, just one question, not related to the future, but one thing. And don't mean to sound fatalist or a pessimist, but sir, how can we put our trust in, say, credit rating agencies when history has proven them otherwise, that they are just as bad as the other investors?
Well, yes, I mean, in 2008, things were pretty bad. I mean, credit rating agencies had assigned a certain rating, AAA, and those guys defaulted overnight. But I mean, those were kind of unprecedented times, and something like that had not happened for a considerably long period in the future. There have always been market collapses over a period of time, so it's not very new to the market. But after every collapse, the industry learns, the regulators also become more aware. So after that, there has been more amount of checks and balances and more amount of regulations which have been put on credit rating agencies as well. So maybe a more robust framework and also having a clear process which they follow for ratings, etc. So regulator can also ask for rating agencies to review their policies and processes to show that whether they are in line with the requirements or not. So I think the we have evolved over a period of time. So every market crash, or I mean, things, of course, global financial crisis is something which was big, but things which happen in the market, and that is something which industry learns from, and that's how we try to enhance the process, because it's very difficult to have a foolproof process in one shot. It's impossible. There are always loopholes. So whenever a loophole is found, then the regulator will also push for plugging that loophole so that things get streamlined. So I would say yes, finally, independence and credibility of rating agencies is important, and I'm sure their policies are also designed in that regard itself, so that their independence doesn't get questioned. So hopefully, going ahead, things would be better. Of course, post the GFC, things have been pretty okay now, but going ahead as well, I think things will improve on.
Sir, can we say that the Glass-Steagall Act would provide a better clarity on how rating agencies are supposed to function?
Yes. So I mean, again, as I mentioned, there are various kind of regulations which come in every now and then, and many a times certain regulations, the regulator says that you either have to follow them strictly or maybe have to follow them in spirit, etc. But I would say even the rating agencies have learned a lesson over a period of time, because even they had burned their fingers when things went wrong, because they had to face lawsuits, etc. as well. So I think gradually things are improving, and regulators globally are also pushing for a more streamlining of the rating process and trying to keep it as independent and objective as possible, so that there is not much interference from the clients who are hiring the rating firms. Now, rating agencies will try their best to keep their slate clean, that they'll have their processes in place. But again, every now and then there are rogue analysts or rogue traders who may want to collude with a certain issuer whom they are rating. So that is something which is more of operational risk, I would say. But otherwise, you have policies in place, and they are there to ensure that the rating agencies function smoothly.
Okay, sir. Thank you.
Now, generally giving you an idea as to how external credit ratings happen. So there are two ways in which ratings are done. One is external credit rating. So this is something which rating agencies do for us. So it can either be a issue specific or a issuer specific. So when it's issue specific, that means the rating agencies are specifically focusing on a certain bond. Whereas if it is issuer specific, that means they are focusing on a certain entity, maybe a certain company. So a general process which is followed as a part of credit ratings. So rating agencies have large teams, and most of them are specialists in their respective industries. So you'll have a team which focuses only on banking, maybe a certain team which focuses on issues or issues only in IT, maybe someone from FMCG, etc. So that way specialists are there. So depending on which company has come to the rating agency with a request for credit rating, a team will be assigned. That team will meet with the company's management. So this is like step one. So this is like a data gathering step so that they know or they try to get as much information from the management as possible so that they can use it for their analysis. Once the management meeting happens, the analysts will go back to their offices and start with a certain qualitative analysis. So this will be analyzing your company's business. So I would say it would either be a top-down or a bottom-up approach because we are to analyze both economic scenarios, company's business, and what all things the management has stated as well. In addition to this, other things which could be assessed is the language of the annual report. So as a part of the annual report, there is a MD and A section, the management discussion and analysis section. So something which explains as to what is the vision of the management and how they are planning to pursue things in the near future. So again, all of these things can comprise a qualitative analysis, then can become a quantitative assessment step, whereby things like financial statement analysis or financial ratios, analyzing various financial statements like balance sheet, income statement, cash flow statements, etc. happens. And at this time, agency might want to apply its internal analytics models as well for doing a quantitative assessment because, as we know, these agencies have been in this business for a long time. So they already have a set process and a certain set of models which they can consume for their day-to-day applications. So these are the ones which are utilized at this quantitative assessment step. Once these two steps are done, a draft report is created by the agency, and this will be circulated within the agency for any kind of feedback or approvals. Because we know that a credit rating agency is a very large organization. So that way, we have multiple teams who are working in order to assign a credit rating to a certain company. So that way, inputs from every team need to be taken into consideration so that any concerns which they have, they are addressed as well. So that's why this draft report is prepared and circulated. People can add their comments and feedback, and again, this draft can be discussed. Once this draft has been finalized within the agency, that final version of the draft will be shared with the subject company, so whose credit rating is happening. So that will be shared with the company's management to seek their feedback and new information, if any, because credit rating can be a longer process. So it can so happen that after the first meeting with the management, some material change has happened, and that is something which the company would like to inform the rating agency. So that's why we say new information. So if there is any kind of new information which is to be divulged, then the company's management would do it at this point so that the rating agency might take this into consideration and revise the draft as required so that it is in line with this new info. Once the draft is finalized by the company as well, and they say that factually things look okay, of course, they cannot have a say on what rating the agency is giving. But any kind of factual errors, that is something which the company is expected to point out because many a times things are done through discussion. So agency will try its best to interpret those discussions in words. But at times there can be factual mistakes which can happen on behalf of an analyst, which is fine, right? Because this is just a discussion. So those factual mistakes are pointed out and they're fixed. But otherwise, inputs from management on what should be the rating, that is not acceptable. That won't be taken as an input. Once the draft is finalized, then a final report gets created, and that final report will be shared by the rating agency to the company, as well as it can be issued to the broader market as well, so that the market knows that this is the new rating. That is the actual rating which is assigned, that gets updated on the rating agency's website as well, so that any consumers who are going to use those credit ratings, they know that this is a revised rating and this is something which is to be used, either revised rating or it's a new rating altogether. So once that is available, then that can be consumed by market participants. And a good place to fetch these ratings could be any of these rating agencies' websites. So generally, what banks do is they purchase a membership or they purchase a subscription for these rating agencies, and that way they can access the individual ratings, or simply they can download a ratings report and use it for their analysis purposes. So this is how generally an external credit rating is done by a rating agency. So any questions on this? Okay. Now something to do with internal credit ratings as well. Now this is something which the bank will do for itself, or it will do, or this will be done by teams which sit within the bank's framework. So a few steps which are followed for assigning internal credit ratings. This is firstly, we start with analysis of customer profile. That is, or maybe even before this, we could do basic things like KYC check, etc. So maybe one step prior to this. So these are the activities which your credit team is very active on. So maybe KYC check or maybe any other info specific to the customer. So when I say a customer, we can think of a certain borrower who has come to a bank. Now, when we talk of internal credit ratings, this means a bank is assigning a certain credit rating to its individual borrowers, so that that rating can be used to decide how exactly the bank would want to treat that particular customer. That is, when I say how they will treat, that means how much would be the lending cost, etc., which they want to charge for that customer. So this very initial steps like KYC check, information collection, etc., is done by what you call as the credit administration team. Credit admin team. And many a times we also call this as the CAD team. So the CAD team is going to collate all of this information. So this is like step one. Everything gets collected. Once that is done, a review begins on what the business model of that particular entity is. Let's say a certain company has come to me and they want a potential borrowing from my bank. So the business model will be tested, their credit history will be checked as well. So historically, they might have taken the loans from somewhere else. So that way, I mean, CIBIL scores, etc., come very handy. So the bank knows whether those guys have defaulted in the past or whether they are good people and they have paid their loans on time. So all of that gets reflected in the credit history. Once this information is taken, then the core modeling activity can begin. So this is also what we call as credit modeling. So for this, you will require analysts which are sitting inside your credit risk analytics team. So as a part of your credit risk team, you may have credit risk analytics, which can form a sub team. So you'll require people who understand the finance and the business part, as well as they're comfortable on the computing side of things. So you're required to do credit modeling. Once this modeling activity has been done, a credit score or an internal rating is assigned. So maybe a bank may decide on a rating scale from 1 to 5, with 1 being the best and let's say 5 being the worst. So based on this rating scale, the bank is going to assign ratings for every borrower which is coming to them. So that way they know what is the kind of risk which every borrower is contributing. So that's what we call as an internal credit score or a credit rating. Now, once this internal score rating or rating is created, again, a draft report is prepared, which is circulated within the bank for approval. Because again, when we talk of a bank, it's a large team. So you have head of risk, head of trading, maybe head of banking, head of compliance, etc., who may want to have their inputs or their concerns addressed. So that's why this draft report needs to be circulated within the bank for any kind of feedback or approval which is to be taken. Next, once this draft report is finalized, Then a final report is generated, which is going to explain what this internal rating is, and that is something which will be consumed by the business within the bank. So once we have this rating ready, then how exactly do we want to use this in our loan system, etc.? That is something which can be decided. But more or less, this is like a general process which will be followed for banks whenever they want to create internal credit ratings for their customers. So any questions on this?
Sir, one question regarding the internal rating. Sir, the banks evaluate each and every, like rate each and every loan that is processed.
Uh, Generally, yes, because the thing is, this is like a ready process for them, right? So maybe if it's a very small account, they may not want to do that. Again, that will depend on what is defined in the bank's policy. But for larger or mid to large size customers, they will definitely want to do this. Maybe for a small time retail customer, they might not want to spend that much time on that.
So, like say, if I avail housing loan, so will I be processed for compliance or credits to the?
Definitely. So because housing loan is a large commitment, right? So imagine that one has to purchase a certain property, it will be worth at least a crore rupees these days. So that way it's a large outlay for the bank as well. So the bank is going to do a comprehensive analysis internally. So that way, yes, for especially things like housing loans, etc., they will do a complete check.
Okay, sir. Thank you. A few applications on credit rating. We have discussed a few, but I think there are a few more here. So firstly, product pricing. So especially you can think of non-SLR debt here. So non-SLR bonds require adjustment of spreads. So depending on the credit rating, we have a certain credit spread which will be used. So that's how product pricing is going to get impacted. For GSEC, it's not a problem, but for non-GSEC, yes, product pricing. Threshold for permitted investments, yes. Then capital charge calculation, because we know that this is something which gets used in your specific risk calculation, because you apply a certain risk weight, which will be applied for your specific risk calculation. Exposure monitoring. So we'll see exposure monitoring in a bit. So what is exposure and limits monitoring? We'll spend some time on that. We know the definition for exposure. We have studied it, I think, a couple of weeks back, which was MTM plus PFE. But how exactly that gets used in your limits framework, that is something which we'll discuss subsequently. Then these can relate to your illiquidity charge as well. So again, we had discussed on a policy which banks apply for managing or doing the provisioning for illiquidity for fixed income products. So based on your rating, the bank will have to classify that bond into a certain category, and based on that, you could have a policy saying that if a certain bond with a certain rating is illiquid, then you need to apply some basis point of illiquidity provisioning. So again, that can be dependent on the credit rating. Then for broad portfolio management as well, this is important because finally a portfolio manager might have a certain mandate which they're following. So they will say that we stick to only investment grade debt. So something similar to our bank's discussion. So again, the overall profile of the fixed income portfolio would change as well. Also, issuer credit rating is important whenever we talk of any new issuances from the issuer's perspective. Because let's say there is a certain company who has issued bonds in the past, and now we know that bonds are one of the sources of capital whenever we talk from the overall capital framework or capital structure for a bank. So if a company has issued bonds in the past, and if they have met all of the interest and principal requirements whenever they come due, that means the company has a decent credit standing. So that is something which gets reflected through their good credit ratings for the issue as well. So the next time the issuer taps the market for additional funding, that can be seen favorably by the market, because whenever participants are going to show interest in a certain new issuance, they are always going to check what was the credit history for that particular issuer. If the issuer has been defaulting in the past, then the new issue may not receive a warm enough response. So that way, the way in which the market perception will shape up, that is something which credit ratings will play a role in as well. And impact on the borrowing cost, again, this is something which we discussed on the previous slide as well.
So I think this covers a few of the major areas where credit rating is used. I'm sure there'll be a few other applications as well, but this more or less covers most of the points. Now, talking a bit on understanding the exposure for counterparties. So we'll try and cover the way in which exposure monitoring happens and the way in which you have a limits framework which is set up. So when we say exposure for a certain trade, that means there are two points to that. So let me, so I think I'll just switch to the whiteboard. I'll just read the point from here and I'll explain you the exposure calculations as well. Let me just switch. So when we say an exposure for a certain transaction, so exposure for a trade, this is given as positive MTM plus PFE. So we'll see how this is calculated as well. So let's take two sample trades in the portfolio and see what will be the exposure for that particular trades or the respective trades. Let me just draw a small table here. Take two trades, so this much should be good enough. So I could have my deal ID. So typically I'll show you how an exposure report looks like. Maybe I can have a nice bifurcation in the center as well. So deal ID 1 and deal ID 2. Then I could firstly have my counterparty name, maybe A and B. Then I'll have my product type. So let's say I have a swap. Just taking an example of a swap, I mean the product type currently doesn't matter. Then I'll have my time to maturity. Let's say this time to maturity is 3 months, and let's say this is 6 years. And I'll have a notional. For simplicity, let's take a notional as 100 for both. After this, I can have my MTM. So let's say the MTM is minus 40 and 30. Then I have a PFE factor. So I'll tell you how this PFE factor comes in as well. So this is the regulatory PFE which we are looking at. So maybe this, I can assign it as 1. I'm just putting in hypothetical factors. The actual factors you'll get to see in the Basel guideline, and maybe this I can just put it as 2. So this is PFE factor. Now I can calculate the PFE for the trade. So just as, or maybe now could be a good time to introduce you to the PFE table. So I've created a PFE factor row here. So this one, if you see, and I've written PFE factors as 1 and 2. So how exactly do I plug in 1 and 2? Now this is driven by your PFE factor table. So this is like a separate table which is available inside the Basel guideline, which talks about how exactly those CCF factors are applied. So they call it as CCF factors, which is nothing but, I think CCF stands for credit conversion factor, which is essentially the same idea of PFE. And here we have the time to maturity or the maturity bucket. And here we have product types. So I could have a IRS, I could have a CCS, I could have FX, etc. And I have 3 buckets which are given here. Less than 1 year, I think this is up till 5 years, and this is greater than 5 years. And currently we have used these factors of 1 and 2, right? So let's use them in sync. So this was 1 and this was 2. Maybe I just plugged in this in as 1.5 for now. And maybe some other factors here, possibly 2, 3, and 4. Now, these factors are not this high, but these are just hypothetical numbers. Actual numbers of the PFE factor can be checked in the regulatory circular. So this is how I decide how much should be the PFE for a certain transaction. So the PFE factor, you can say, is a function of product type and the time to maturity or the maturity bucket. Now I have a IRS. So imagine that this 1 and 2, I have not written them now. So let's see how do I write 1 and 2 now. So I have a IRS and I have a time to maturity of 3 months. So I'll look at the column for IRS, which is the very first column. And then I have to look at the time bucket which I'm falling in. So my time bucket for the first trade is 3 months. So that's how I choose 1 as the PFE factor. So I write a 1 here. Next, I go to my second transaction, again an IRS. It has a time to maturity of 6 years. So again, I stick to IRS and I choose which bucket I'm falling on. I fall in the third bucket, which is greater than 5 years. So my PFE factor becomes 2. So that's how I get a 2 here. Now I need to calculate the PFE. Now when I say 1 and 2, it is 1 and 2 of what? It is percentage of notional. So you can imagine this is 1% and this is 2%. So 1% of notional, which is 1 unit, and 2% of notional, which is 2 units. So maybe I can just put in the percentage here to avoid confusion. So that's how I get the actual PFE number. And then I can calculate my exposure for the transaction, which is MTM plus the PFE. So can you guess what will be my exposure? We already have the formula which is written here. So you can use this formula for exposure. And can someone tell me what will be the exposure for trade 1 and for trade 2? So these two are the relevant columns which you have to look at, MTM and PFE. Focusing on these columns, can you try what will be the exposure?
So if the MTM is negative, do we consider it as 0 or do we take it as negative 40th?
Yes, we'll consider that as 0. Yes.
For trade 1, would it be just 1 exposure?
Correct. And for trade 2?
32.
Correct. Very good. Yes. So that way we ignore negative MTM. So the reason behind that is whenever we have a negative MTM, that basically implies that we are not really in the money for a certain trade. That is, your MTM gives you your current credit risk. So if your MTM side is negative, that basically implies your counterparties are the one who should be worried about the exposure. Because tomorrow, if I default, they stand to lose something. So negative MTM is a problem for my counterparty, not for me. Now, for me, I'll be flooring that MTM as 0. So that's why I have mentioned it as positive MTM. I will not be taking any kind of negative MTMs into picture. So for the first transaction, I'll just have the PFE component. I'll not have any MTM. So that's why the exposure is 1. For the second transaction, yes, I am in the money at the moment. So I have an MTM of 30. So that is if tomorrow my counterparty is to default, I stand to lose something. So this is my current credit exposure, which I need to take into consideration. So this 30 will be used. So 30 plus 2 gives me 32. And this is how I can calculate exposure for any trade. Now, though, I could have 10,000 trades in my book as well, which could be a mix of IRS, CCS, options, FX, even interest rate futures as well. So for every transaction, I'm going to follow a certain, this similar logic will be used. I'm going to use the same PFE factor table, and then I can calculate the exposure for every trade. And this is what you call as exposure calculations. Again, something which happens on a daily basis. So banks are expected to calculate their trade exposures on a day-to-day basis. So if I am, imagine that today, let's say today it's 9 a.m. in the morning. Let's say we are in office right now. So I have yesterday's data. So I have 30th March data available for me. So I'll be using that 30th March, which was yesterday's data. And today at 9 a.m., I start with analyzing my exposure numbers. So that way you always use the previous day's end of the day numbers and use it today. Like today is a very crucial day for any bank. So tomorrow all the banks will be working in full swing. Of course, they'll be close to the public because it's annual closing, but otherwise banks will become busy since it's 31st of March. Now, these are like crucial data points. So in case any of you happens to join a bank at a later point in time, you'll realize the importance of these quarter end dates. So quarter end or especially year end dates. Now these are considered as very crucial dates. So everyone wants to ensure that all of the calculations are in line. So nothing can go wrong here because these numbers are going to be distributed everywhere. So maybe one of the days during the month, let's say one of your number is off. Possibly you're trying to enhance your system and something went off and your number was not ready in time. That was acceptable. But for a month end or quarter end or year end especially, now these things are simply unacceptable. So for the next 2-3 days, I'm sure banks will work on this weekend as well. So risk teams within banks will be busy on the coming weekend because every bank is in a hurry to announce its financial results. So they'll say you work on the weekend and we want the numbers finalized by next weekend. So that way it's going to be a busy time. But apart from what actually happens, this is something which is important and which you'll see in your system as well. So these are your exposure monitoring reports. Okay. Total exposure. Okay, so what's the time? Do we have time to see exchange of limits? Not really. Okay, so there is one thing which we call as limits monitoring. Now, limits monitoring is something which will take time. So we'll not do limits monitoring now, but I'll give you an idea of what happens for CCL-backed transactions whenever you're doing exposure monitoring. So that is something which we can quickly discuss now. So when I say CCL, not just CCL, but any other CCP, I would say. Now, whenever we have a CCP in place, that implies that the clearing and settlement of the transaction is the headache of the CCP. So the advantage for CCL-backed transactions is you may have exposure to these trades. However, when you actually calculate the cumulative exposure at a certain level, there are certain exceptions which are available. So especially those trades which are backed by CCL or any other CCP for that matter, that is something which does not get used when you finally calculate your credit exposure. So credit exposure is nothing but your positive MTM plus PA fee, which you adjust for collateral. So those of you who are interested, I had recently written an article on exposure monitoring. So that's there on my website as well. You can check it out later. So that can be a decent starting point, and subsequently you can check out the guideline as well. But the point here is whenever you, so again, the point here which I want to make is the importance of having a CCP cleared transaction. So there is an increasing push by banks towards moving trades on the CCPs as much as possible because there are immense advantages to doing that. Firstly, something which is backed by a CCP is something which you can ignore from your exposure monitoring framework. Of course, there are certain conditions which are to be met, but more or less that gets ignored from your exposure and from your capital charge calculations. So that frees up considerable amount of capital. Next is the bank doesn't have to bear the headache of managing the clearing and settlement for a CCP backed transaction because you have a separate entity to do that for you. So as compared to bilateral netting, a centrally cleared transaction is always preferable. Now, of course, the thing is CCP is not going to provide clearing and settlement for every variety of products. It's not possible. CCPs are there to support only standardized varieties. So maybe a standardized IRS or a standardized single name CDS. These are the things which CCPs support. But the increasing push on CCPs is to reduce your exposures more because as we reduce the exposures, that means we can do more amount of business with a certain entity. Now, this relates with what we call as limits for a certain entity. So you can imagine that for counterparty A, I have a certain threshold which is defined. Now, that threshold is what I call as a limit. So that limit implies that I can transact with counterparty A only up till a certain exposure limit. I cannot breach that limit. So that puts a cap as to how much amount of transactions I can do with counterparty A. Now, if I know that counterparty A trades can be very profitable for me in the near future, what I could do is I would try and push more transactions on a CCP. So that frees up my exposure calculations for counterparty A, and I can do more business with counterparty A. So more about exactly how limits monitoring happens and what is fungibility of limits. So there is an idea of treasury limits and trade limits. So what is the limit framework, how exactly that is monitored, etc. That is something which we are going to cover in the next class because that will take close to 20-25 minutes to understand. So I'll give you an idea of what that limits module is. So that's also called as a real-time limits module in your treasury systems. So be it Calypso or Murex, you'll have this kind of a limits module which operates. So we'll understand what that model is when we meet the next time. So good. So I think this was what I had planned for today. So we have covered a decent ground today as well. I mean, we did a quick walkthrough of the VAR model. So I'll share the Excel with you guys. You guys can check it out. And also, we started a discussion on some bit of credit risk side of things. So things like credit ratings or exposure monitoring, etc. So when we meet in the next week, we'll take the discussion ahead. So I think now on Saturday we don't have a class because it's Gudi Padwa. That's why we have this rescheduled class today. But so your exams will be from 4th to 6th, is it?
Yes, sir, correct. So Monday and Wednesday, we would not be having a class, I imagine.
Correct. So on Thursday, you guys are available at the same time, is it? Of course, I can check with Shrikant sir, but if you guys are available, then we could meet on next Thursday as well.
Yes, sir, Thursday. I don't think anyone has any papers, but you'll need to check the
Okay,
schedule as to what time slot
I
is.
can correct. I can check with Shrikant sir, and anyways, we have a class on Saturday. So we'll try to finish everything by 11th because I have a travel plan from 14th. So after 14th, I am away for a few weeks. So I'd like to complete our discussion sessions before that. So that will be the target. All right. So let me quickly take the attendance, and then you guys can disperse. Also, wish you guys a happy Gudi Padwa. Have a good weekend with your family and friends.
Thank you, sir.
So I'll take the attendance. Yeah, Akash Singh, Achal Jain, Ayush Bhushan, Adesha Hati, Tejas Akware, Ali is present. Anjali Garg, Anmol Sen, Arismita Deka, Avdi Mishra, Ayushi is present. Ayushi Rotagi is present. Sarvesh is present. Bhavya Dang, Cherry Chabra, Diksha Chauhan, Dipansha Singh, Gaurav Kadam,
Present.
Gaurav Datir, Himanshi Verma is present. Jaideep is present. K. Ayushi, Riya Shukla, Priti Marwa is present. Mansi Singhal, Mansimran Arora, Manvi is present. Mihir is present. Muskan Garg, Namrata Gaur, Neil is present. Nikhil Agarwal, Prasoon Sharma, Pratik Maheshwari,
Present, sir.
Rachit Tyagi, Rahul Ghosh, Rahul Giri, Rahul Goswami, Rajaditya is present. Rashi Jain,
Present, sir.
Rishabh Kothari, Ruma Keshri, Sahaj Manocha, Samiksha Chopra, Sharanya, Shubham Jain,
Yes, sir.
Shubham Kumar, Someshwar Verma, Suti Mehrotra, Sanika Thakur is present. Vinay Pawar. Okay, so financial economics is done. So you guys can leave. I'll quickly take the attendance for IB. Thank you. Ayush Sharma. I'll read out names who are present. Let me know. Alisha Gupta, Vidhi, Anant Jain, Anish, Anjali Sethi, Arshada Imam, Barka Israni, Bhavya Patel, Saloni, Chaitra Tirodkar, Devam Pandey is present, right? I think I'd seen Devam's name. Diksha Kalra, Gauraja Nevatia, Gayatri Govind, Govind Mittal, Sawan is present. Himanshi Veermani is present. Then we have Indu, Ishita Saxena, Kanika Goyal, Khasro L. Lakshay is present. Mahi Rajawat, Mansi Gupta, Mathangi Warrior, Megha Parak, Nancy Halawat, Neha Jain, Pratishta Pradhan, Rohan Bagai. If anyone is present, let me know.
Sir, Anjali, Arshada, and I, Vidushi, we are present. We're attending on the same laptop.
Okay. So Anjali, Arshada, and Vidushi. Okay, yeah.
Yeah.
Rohit Podar, Samida Malik, Shivangi Semwal, Simran is present. Srishti Verma, Tanu Goyal, Tarang Kadyan, Kalyani Todkari, Twinkle Karnawat, Vaishnavi Srotriya, Vanishka Jain, Vibhor, Vidushi is present. Yash Mehra. All right. Great. So thank you so much. Thanks for joining in and have a good weekend ahead. And I look forward to meeting you in the next week and wish you good luck for your exams.
Thank you, sir.
Thank you.